one can say, well, if market is getting more efficient, is the pool of alpha getting smaller and smaller every year? Well, and the answer is the pool of known alpha is getting smaller and smaller every year, except those pools kind of multiply. As the world grows, as beta grows, the alpha that follows that beta it also grows. So number of inefficiencies or places for inefficiency increase.
Hello everyone, I'm Vincent and this is Resonance Spotlight, the podcast where we explore investment strategies, learn the stories behind them and meet the expert who create them. In today's episode, we explore the concept of alpha, a key driver behind daily investment decisions involving trillions of dollars. Alpha's importance in the investment world cannot be understated, yet it presents unique challenges. We'll discuss its practical definition, where to find it, and why its scarcity creates difficulties for both small and very large investors. Small investors may struggle to access alpha, whereas for very large investors, it might not significantly impact their portfolios. Join us as we dive into these topics with Dr. Misha Malyshev, widely known as Misha. Misha is the CEO and CIO of Teza, a niche multi-strategy platform known for its high-frequency trading infrastructure and its team of over 80 PhD-level professionals across 5 offices. Before founding Teza in 2009, Misha served as a global head of high-frequency trading at Citadel, a position he took up in 2004 after roles as a management consultant at McKinsey and as a researcher at Bell Labs. Misha earned his PhD in astrophysics from Princeton University and holds degrees in theoretical physics and mathematics from the Moscow Institute of Physics and Technology. Misha, welcome to the show and good to have you here.
Thank you, Vincent. Glad to be here.
Before we deep dive into our main topic, would you mind giving us a brief introduction of Teza and your current role there?
Sure. I think you've done it perfectly. I'm CEO and CIO of Teza, which focuses on very unique and niche strategies with the value proposition to investors as a very orthogonal set of alphas to add to their portfolio.
Now I find you have a very fascinating background. I mean, it's not unusual to find science PhD doing investment, but you managed to go from a research lab to management consulting, high-frequency trading, and investment strategies. So how could this all happen?
Yes, that's true. And I like to say that half of my adult life, I've been a scientist in Moscow Phystech, and then Princeton, then Bell Labs, and then I turned, quote unquote, turned to the dark side and went to McKinsey. It was an interesting experience because in science, you deal with logic and facts and strict definitions, and in management consulting, you deal with emotions and humans, and that was a very unique experience. Kind of after doing physics for so many years, diving into the human psychology.
So what were the biggest change or technology shift that you witnessed in markets, if you have to compare your early days to today?
Interestingly, we are participants in the markets from a very unique perspective. We are scientists and technologists who are playing investment game or participating in investment activities. So we'll look at the markets through the prism of science and technology. So when you ask what are the biggest changes that happened to the market over our lifetime, over the lifetime of our company, I would say those are definitely technological changes. So when we look at the markets, and it's actually tied to your initial question about alpha and beta, the market efficiency that is sort of a relentless evolution, right? Like market is getting more and more efficient, and one way market getting more and more efficient through actually development of technology. So technology delivers higher information dissemination, higher information gathering, higher information processing, higher information accumulation. So when we talk about higher information dissemination, we're talking about like ultra high frequency world. And since we've started Teza, the frontier of high frequency changed from being a microsecond time reaction. Microsecond is obviously 1/1,000,000th of a second, to 100 of nanoseconds to currently 10 nanoseconds. And nanosecond is 1/1,000,000th of a second. So we're talking about times where computers, your normal computers, are not fast enough. So we're talking about special applications called FPGAs. Those are like tiny silicon chips that allow you to react to something happening on the market, not in a blink of a second, but not in a blink of a millisecond or microsecond. It's a few nanoseconds. So that definitely happened, right? Like the speed of reaction time to what's happening to the market by variety of different participants increased. The speed of data delivery has increased. We're talking about, since we started the company in 2009, the speed of data delivery between two major trading points, between Chicago and New York, between Aurora, Illinois, and exchanges in New Jersey, increased from from give or take 15 to 20 milliseconds to initially to just under 5 milliseconds, and then later on even further.
Thanks, Misha. So my knowledge of high-frequency trading or market making is really limited to the movie Trading Place. That A-Teams movie with Eddie Murphy. So when you talk about speed getting faster, is it just a replacement of before the ability to shout louder or physically push your peers just to get in front of the order flow?
That's perfect analogy. I know old bond traders used to be all 6 feet tall and huge, and former football players, for the reason of being able to push themselves closer to the pit. And yes, currently working on nanoseconds is an analogy of shouting louder or making this gestures with your hand by cell much faster than the person nearby would do. So it's definitely technological way of making market more efficient, right? So rather than humans doing it, right now it's done through ways of technology.
Okay, right. But now, if you're not a market maker, you're an asset manager. How does this affect you? Is it something you can benefit from?
For sure, it's the if you think about various horizons of investment activities, right? Like starting with the very, very large horizon, which is buy and hold. So buy and hold, that's where beta lives, right? Like all the way to high frequency, where the smallest of the alphas live. So each sleeve of that time horizon provides opportunity for another sleeve to be in more efficient market. So competition and high frequency allow fund managers to trade at with better liquidity or at more precise prices. So without market making or high frequency activity, people who trade on the daily horizon may have not have gotten the right trade or the right price, right? So the fact that market makers and high frequency traders remove inefficiency in price discovery by making sure at any point in time price is as close to fair as possible, actually providing a service to an intraday traders. And intraday traders who take positions maybe like overnight, they provide the service to longer horizon traders. And that's how the whole chain works. Of course, you have to pay for that, right? So and on the other side, when you provide the service, you demand payment. So asset managers do pay to high frequency traders and market makers for liquidity that they seek.
So you mentioned initially the more intense competition or efficiency at the very first level. But what I've also noticed is that at the medium-term level, with the proliferations of tools like Python Pandas and some open source statistical analysis library, the barrier to entry for doing things like classical medium-term trend following has been dramatically lowered over the last decade. So where do you see your competitive advantage in this spectrum ranging from the very super fast trading strategies to the medium-term 200-day type of moving average?
Yeah, actually, it's a good question. And the way we do it and the way we always have done it, our competitive advantage always come from the intersection of different areas, from intersection of different horizons or intersection of different activities. So we are not trend follower, right? We are not doing simple CTA-like approach, and we believe, right, like at this point, it's a commodity, right? Like you said, anybody with the Python notebook, any 10th grader with the Python notebook can create a CTA-like strategy. So the question is, and therefore, those strategies are not high quality strategies. They don't carry high Sharpe ratio behind them. So what we do, we try to get units of information from one area to transfer this information to another area by focusing on microstructure and by focusing on other people's market impact. So when people trade, they create market impact. It's super important concept in the market. We like to say that when people say there are only two things, death and taxes, we like to say, well, there are only three things: death, taxes, and market impact. And market impact is the one that you cannot cheat. So if you have to buy something, you have to pay up, right? So when you decide to buy extra amount of gold or oil or particular stock, you are going to push the market higher. And when you decide to sell it, you are going to push the market lower. Understanding that market impact and its dynamics on the very, very granular level allows us to take advantage of inefficiencies which people create by creating that market impact.
So coming back to our main topic, we wanted to discuss about alpha. And the first thing about alpha is, everybody has its own practical definition. So as a starting point, I'd be curious to hear about your take on this.
Yeah, I think when we talk about alpha, probably it's worth first defining beta, because that requires probably less controversy, right? So by beta, we essentially define strategy that is buy and hold, right? So for example, there is beta of US market, right? Like you can buy S&P 500 in one form or another and hold it for a long period. Obviously, beta is the biggest investment game in town, because that's the largest opportunity in terms of capacity to make money. And alpha is trading around inefficiencies. So rather than buying every single stock in S&P 500, if one can figure out that one stock is going to perform better than the other stock, then the typical alpha game would be to buy a better stock and to sell stock that is much worse. In which case, it would be market neutral, so no trace of beta in the strategy, and it would be defined as alpha. The necessity of alpha typically to investors is comes for two reasons. It can be completely orthogonal to beta, right? Like, or at least I would define alpha completely orthogonal to beta. As you know, some funds would mix beta and alpha together, but most of the sophisticated investors would not go for it.
So when you're looking for alpha, what market are you typically looking at?
As I said, we are starting with microstructure. We're studying market impact of other people, and knowledge of microstructure, the data set that I described, the uniqueness of the data set, our ability to see through, kind of our ability to have a particular microscope to look at this data, allows us to identify patterns on any market that is governed by economic laws. And there is only one economic law in the market, is supply and demand. It's that balance between supply and demand pressure that determines the change in price. There is no other, you can say, sentiment or fundamentals or any kind of quantitative pattern, but in the end of the game, in the end of the day, right, like it's the balance between supply and demand that pushes price up or down. So if you can focus on this most fundamental concept of balance of supply and demand, and if you can say that the supply will exceed demand or demand will exceed supply, if you can focus on that, you can determine where the price is going. So therefore, your question is, which markets do we trade in? Anything. Then any market that allows you provision, allows you collection or identification information that you can get about the activity on that market. Any market is good. It can be US equity, Chinese equity, Indian equity, which is traded through futures mostly, global commodities, gold, FX, anything. So as long as you have electronic limit order book to which we can connect and listen to, we can get the information from this market and we can trade on that.
Okay, great to hear. Given your extensive experience in quant finance across various cycles, could you share your insight on the major trends currently shaping the market and the competitive landscape?
The interesting thing in this whole game, the high level view on this, that there is not enough alpha in the world. And not enough alpha in the world leads us to the question of capacity. If you talk to any manager who has a particularly niche strategy or high Sharpe ratio strategy, you'll probably very quickly discover that capacity of that strategy is limited. Right? That strategy is what is called capacity constraint. You look right now at the most successful multi-strategy funds. Most of them are closed. Most successful are closed because they're operating at their capacity. So the main trade or the main trend in that space is that lack of capacity with increased demand for those strategies, with increased demand for alpha. And everybody looking for another multi-strat, another successful multi-strat. The reason being is when you put several different orthogonal strategies together, right? Like you can significantly improve the quality of your return, the Sharpe ratio of your strategy. So even though you're neutral, and that's what happened in August of 2007, right? Like that was kind of the quant earthquake when most of the market neutral funds who thought they are completely risk-free before that, like experienced Armageddon type of event. Now, why does it happen? Well, it happened exactly because that space is already capacity constrained. Most of the people, one way or another, pushing in the same direction, right? Like taking position in the same direction. So when the last person who cannot compete begins to liquidate, it's actually in that process, it creates an earthquake for everybody else.
I think you wrote an interesting paper on that topic. Where do you see the sweet spot?
Yeah, I think probably the sweet spot in terms of the size of investor, the sweet spot is probably from $1 billion to $10 billion, right? Like that kind of a horizon. That's where you can afford to be very, very sophisticated in your due diligence. At the same time, you're not too big that you don't know where to put your capital. right? Obviously, your typical sovereign funds with the $1 trillion plus portfolios, right? Like they are destined to beta investment, right? Because there's just not enough alpha.
So now I have a somewhat nerdy question for you. As a scientist, there's likely an investment channel that you hold dear, one that you find yourself returning to repeatedly, almost like a pet problem, but in the best way possible. Do you have such a problem?
A pet problem. Yeah, we are trying to build a multi-strat. We are trying to do it in a very different way from other people. We believe that just recycling of managers coming from one place to another, then to another, is not an interesting way to go for us. We are trying to figure out like what can we invent which would be different from other people, and it's a challenging problem. The reason it's a challenging problem is that you at the same time you're trying to focus on what you do well and diversify. So diversification basically means do as many things as possible. Focusing on what you do well means do as little things as possible. So that balancing act of how you focus on only where you can really make the difference, and at the same time make it as diverse as possible, is an interesting problem. That's actually another interesting segue, because one can say, well, if market is getting more efficient, is the pool of alpha getting smaller and smaller every year? Well, and the answer is the pool of known alpha is getting smaller and smaller every year, except those pools kind of multiply. As the world grows, as beta grows, the alpha that follows that beta, it also grows. So number of inefficiencies or places for inefficiency increase, right?
Yeah. I have to ask you about your take on AI. That's the hottest topic of the day. So yes, there is the burst, but beyond that, do you see anything significant, any significant change for your domain? Are there particular opportunities, or are we just talking about increments?
It's a fantastic question, and we've been into call it AI, or what we call neural nets or deep learning, kind of more specifically, for a while right now. And if you think about neural nets, there are three stages of neural net attack on Wall Street. The first one happened in 80s, where neural net first appeared on Wall Street, and everybody thought, oh my God, like what a great concept. If it does something good, you put a little bit more sugar. If it does something bad, you put a little bit more acid, and you keep on training it until it supplement a human trader. So that failed. Then in 90s, there was a second wave of neural nets, like the let's call it support vector machines, where people say, okay, like that whole thing that we tried before didn't work because we were sort of like, it's really, really hard to train black box. So let's kind of like stick the electrodes into the black box and control this training process. And people tried it again, and that failed. And then there was a period where people kind of forgot about neural nets. And then, of course, in 2012, Hinton and the crew revived it. And in 2017, of course, there was a first paper on transformer. Attention is all you need. And that paper basically was the beginning of what right now called AI, ChatGPT, and all this stuff, transformer-based technology. So we've been into that game for a while, except cautiously. Cautiously, in what sense? It is very, very easy for machine to deal with complexity when the certainty, like when there is a high certainty of the outcome. For example, chess or even Go. The outcome is very, very certain. Is a draw black wins or white wins, right? Like there are three states. There is nothing in between. It's not like, oh, oil can be a little bit lower or maybe a little bit higher, or the price of gold is that way. So it's very, very certain state, while complexity of getting there is very high. So humans don't deal with complexity, but humans deal better with sort of like less certainty. So there's joke is that human traders see a trend where there is not even a trend, and a machine, of course, cannot see that trend even when there is a trend because of high noise.
Misha, thank you for being with us today. I really enjoy our discussion, and to our listeners, thank you for tuning in to Resonance Spotlight and for making it this far through these episodes.
Thank you, Vincent.